Welcome to my individual assignment section for portfolio management. Firstly, I focused on the quantitative equity investing proportion of the assignment, which focused on the evaluation and back testing of industry momentum strategies. I utilized Microsoft Excel to help me determine the winner and loser portfolios through assessing the risk-adjusted returns and also the Sharpe ratios. Specifically, I completed questions 9.6 and the additional question 9.7. In question 9.6, I analyzed each industry in the provided data to determine a consecutive pattern of momentum loss for 3 months. Firstly, I analyzed the market performance over 2009 to determine any trends in losses, gains, or general stability. After this, I compared it against each month of 2009. For the industries, I calculated the average total return for each month in 2009 to help determine a general trend from month to month. From this, I calculated the difference in the average total return between each month to determine whether industry momentum was gained or lost. I also did this for the market in general. The result showed that industry momentum experienced a loss from 20.5% to 7.49% in March. In April, losses continued to negative 11.26% and then to negative 6.69% in May, before finally achieving an upward gain to 11.81% in June. To determine why this may have been the case, I researched potential macroeconomic events that occurred between these months, viewing reports, articles, and financial analysis documents. Additionally, I looked into the specific industries more deeply to determine whether specific events cause these losses. I determined that the market during this time was recovering from the events of the GFC, where investors were still relatively bullish on the market. Additionally, those industries experienced a downturn during these months, leading to businesses within these industries to experience a contraction due to a lower goods and services demand. For question 9.7, I calculated the arithmetic average annual volatility for each industry to then find the annualized Sharpe ratio for each industry's momentum. I did this to help order the industries into the number of best winner and worst loser industries signified by N. After ordering these industries by Sharpe ratio, I found that the Sharpe ratio for the number of these industries in the winner portfolio and loser portfolio steadily increases until N equals 7. This means that historically, buying the top 7 industries and then short selling the worst 7 industries provides a Sharpe ratio for industry momentum of 1.06. In conclusion, the sections that I completed of the report helped in understanding how selecting high-ranking industries were important in reducing volatility. We were able to find that the winner portfolios generated positive returns with lower volatility, and the loser portfolio generated decent returns, but did not compensate well or the level of risk taken initially. Thank you for watching my presentation.